So, you own shares in a stock that just keeps trading sideways, and you'd like to create cash flow beyond just dividends. If this is you, then the covered call strategy might just be what you're looking for. The covered call is an options trading strategy where the trader sells a call option against an underlying security that they already own. As the underlying security trades sideways or down, the call option you sold will collect premium from theta decay. The difference between the gray dotted line, net with premium, and the black dotted line, net without premium, is your profit. If you recall, theta decay is the extrinsic value of an option, meaning it is the value above and beyond the delta with the strike price, or intrinsic value. It is this extrinsic theta value that allows the seller of the option to reduce risk and profit. That's you. Okay, here's some do's and don'ts to covered calls. So things you'll want to do. Avoid holding your covered call option through earnings. Remember, earnings can cause volatility and a stock to jump. If the stock price is over the strike price at expiration, you will be forced to sell the stock at the strike price. You'll want to ensure that the premium is enough to make you comfortable with the trade. You'll also want to pick an expiration date 2 to 3 weeks from expiration, as that's when most of the options premium is collected. Allocation can happen at any time, although it is more likely when you're near expiration and above the strike price. If you're holding your shares long for long-term capital gains, allocation can ruin your tax strategy. So if you're in the allocation danger zone, you may wish to exit the trade. Here are some don'ts to the covered call. Don't use the covered call on small and mid caps that are volatile. Instead, use them on large caps that are less likely to be bought out or have a large jump in price. Don't sell covered call options in the run-up to earnings or hold through earnings, as earnings can cause volatility that goes against your trade. Also, don't sell covered call options if you expect substantial positive news in the expiration window. So the next time you're holding a stock that's just treading water, selling a covered call might just be the right strategy to increase your profits. If you have a question about the covered call strategy or any strategies, drop a comment below. Next up in this series is writing a cash secured put. Click the link in the video to learn more.